Welcome back to Smart Stock Sam, where we cut through the noise and give you the real edge on the market. I'm Sam, and before we dive in today, I need you to stop whatever you are doing, because what I'm about to show you in the next few minutes could be the most important thing you watch all week if you are holding SanDisk, ticker SNDK, or even thinking about it. Today, we are doing a full strategic audit on SanDisk. We are going to cover the jaw-dropping numbers behind the rally, the tectonic shift in its business model, the global risks that are building right now, and a very specific trade blueprint for the week of May 18th through the 22nd. And here is the question I want you to sit with as we get started. What if the single most dangerous week for this stock turns out to be the most profitable window of the entire year? Stay with me, because by the end of this video, you will know exactly how to think about that. Let me set the scene first. 1 year ago, if you had put $10,000 into SanDisk, you would be sitting on over $330,000 today, 3,300%. Not a typo, not a meme coin, not some sketchy penny stock. This is SanDisk. And yet, right now, right at this very moment, we are at a crossroads where the next 5 days could either be the launching pad for the next leg of this run or the beginning of a serious correction. The difference between those two outcomes comes down to a handful of very specific signals, and that is exactly what we are going to map out today. I want to make sure you walk away from this video with a clear, actionable picture. So here is what we are covering: the parabolic chart and what the cool-off really means, the fundamental engine driving this stock that most retail investors are completely missing, the external risks that hit the tape last week, who the big institutional money is doing right now, insider activity that should make you ask hard questions, what the analyst community is actually split on, the technical indicators showing exhaustion, the options chain battleground for this week, 2 major volatility events on Wednesday and Thursday, and finally the full trade blueprint with exact levels. Let us get into it. First, the chart. If you look at the 12-month price history for SanDisk, it is almost incomprehensible. The stock surged 482% just since January alone, reaching an all-time high of $1,600 on May 11th. And here is what is fascinating. The chart on the right side of that peak is not a collapse, it is a cool-off. The stock has pulled back to the $1,407 range. Now, most people see a drop from $1,600 and immediately start asking whether the bubble is popping, but professional traders look at this and see something completely different. They see a consolidation phase. That $1,400 level is not a random number. It has become the battleground between the bulls and the bears, and the reason this consolidation matters is not just technical. It goes much deeper than the chart. The real question you should be asking is, what changed inside this company to justify a move like this in the first place? Because the answer to that question is the foundation of everything else we are going to talk about today. Here is what most people are missing. SanDisk is not the company that makes the thumb drive in your junk drawer anymore. They have undergone a complete DNA transplant. In their most recent fiscal quarter, Q3, they posted $5,950 million in revenue. But the number that stopped Wall Street in its tracks was the earnings per share. The street was expecting $14.17. SanDisk delivered $23.41. That is not just a beat, that is a historic beat. And buried inside those numbers is the real story: a 233% sequential jump in data center revenue. Sequential. That means quarter over quarter, their AI-related business more than tripled. But here is the hidden metric that I keep coming back to, and this is the one that most retail investors are not talking about: the $11 billion in structural guarantees. Historically, the memory business was a commodity business. Prices went up, prices went down, and companies just rode the cycle and hoped for the best. SanDisk has now secured multi-year contracts that shift them away from those volatile spot markets toward predictable contracted revenue. That is a complete de-risking of the business model. That is why the institutional money has been piling in, and that is the foundation that makes the bull case real rather than just hype. But here is the thing about even the strongest fundamentals. They do not exist in a vacuum, and the macro environment does not care how good your earnings were last quarter. So let us talk about the risks, because this is where it gets uncomfortable. On May 12th, a proposal emerged out of South Korea for what is being called a special AI tax, and the moment that hit the tape, it sent a shiver through the entire semiconductor sector. Simultaneously, inflation data came in hot. The consumer price index for April clocked in at 3.8%. When inflation stays elevated and Treasury yields rise in response, high-growth stocks like SanDisk take a hit because rising yields effectively reduce what future earnings are worth in today's dollars. But the single biggest wildcard for this specific week, the one I want you to have circled on your calendar, is the Samsung Electronics strike, an 18-day work stoppage set to officially commence on May 21st. Samsung is a titan in the global memory space. Could their supply disruption drive prices for SanDisk products higher? Potentially. But it could also create chaos in the global supply chain that rattles investor confidence at exactly the wrong moment. And that brings us to who is actually holding this stock right now. Follow the big money. Institutional ownership in SanDisk is sitting at 86.65%. The professionals are driving this bus, and they are not all moving in the same direction. On the bull side, David Tepper's Appaloosa Management, one of the most respected hedge funds in the world, built a $179 million stake in just the first quarter of 2026. When a billionaire with Tepper's track record makes that kind of commitment, you pay attention. But here is the other side of that coin. John G. Ullman and Associates recently reduced their holdings by approximately 41%. Same stock. Same time period, completely opposite move. One institution is betting on the AI moonshot, and another is locking in 3,000% gains and walking away. When you see that kind of institutional tug-of-war at these price levels, it tells you one thing with certainty: you are at a critical valuation pivot point, and the institutions are not the only ones making moves. The people inside the building are too, and what they are doing deserves a hard look. On May 12th, Chief Accounting Officer Michael Pokorny sold approximately $3,500,000 worth of stock at $1,426 per share. A few days before that, Director Nasip Sainer also unloaded shares. Now, to be fair, executives have bills to pay, taxes to manage, and pre-scheduled trading plans. Insider selling is not automatically a red flag. But when you see it clustering at the $1,400 to $1,500 range, it does suggest that the people who know this company best might feel the stock is fairly valued for now, not necessarily that the long-term story is broken, but that the short-term upside may be limited from here. And while we are on the topic of things that should make you pause, there is one more development I need to flag directly. The board just filed an 8K urging shareholders to reject an unsolicited mini-tender offer from a group called Tutanota LLC. They are offering to buy shares at $1,150. That is dramatically below the current market price. This is a well-known tactic used to catch retail investors who are not paying close attention to what their shares are actually trading at. Do not fall for it. It is essentially a lowball offer designed to operate below the thresholds that would trigger normal SEC oversight rules. If you get this offer in the mail or in your brokerage account, reject it immediately. Now, what does the analyst community actually think this stock is worth? The answer depends entirely on which camp you ask. On the bull side, Susquehanna just doubled their price target to $2,000, citing the massive AI tailwinds. Cantor Fitzgerald is not far behind at $1,800, focusing on what they are calling a $42 billion book of future obligations. Those are enormous numbers. But then you have the value camp, firms like Wells Fargo and Barclays, who are keeping their ratings at equal weight. Analysts speak for wait and see. Their concern is the valuation. At current prices, SanDisk is trading at a 48 times price-to-earnings ratio. In the semiconductor world, that is expensive. The worry is that the cycle may be peaking and that the stock has already priced in every piece of good news. So, who is right? The answer to that question is being written right now, in real time, at the $1,407.61 pivot level, where everything is currently converging. Think about what we have stacked up on either side of this price point. On the upside, the data center boom, $11 billion in guaranteed revenue, historic earnings beats, and Tepper's money. On the downside, a 48 times PE ratio, rising treasury yields, insider selling, and a Samsung strike about to kick off. The result is what technicians call a tense consolidation. The stock is coiled like a spring, and it is waiting for a catalyst to tell it which direction to explode. And the technical indicators are giving us some important clues about the short-term direction of that tension. The MACD, which measures price momentum, is currently sitting at negative 8.92. Short-term sell signal. Bullish steam has run out for the moment. The RSI is at 48.58. Earlier this month, it hit 80, dangerously overbought. Now at 48, the pressure has released, but we have not reached oversold territory either. Most critically, we are currently trading below the 20-day simple moving average, short-term bearish. But we are still way above the 200-day simple moving average at $1,105, meaning the long-term uptrend remains fully intact. And before anyone asks, this is not a short squeeze setup. Short interest is at 11.47%, but the days to cover ratio is just 0.9. The shorts could exit their entire position in under one trading day. Borrow fee is a tiny 0.28%. No trap, no squeeze. This is a fundamental and institutional story, full stop. Which brings us to the options chain, because this is where the professional money shows you exactly where it thinks the battleground is for this week. The $1,400 strike price is the absolute epicenter. Over 1,000 put contracts and roughly 500 call contracts are sitting right there, which tells you the market is expecting the stock to orbit that level. Looking above, there is heavy resistance stacked at $1,450 and $1,500. Professional option sellers have essentially built a wall at $1,500 for this expiry. And on the downside, massive bars at $1,100 and $1,000 suggest the market sees those levels as a safety net, even in a worst-case scenario. That gives us a very defined trading range for the week. Now, the two dates you absolutely need to have circled. Wednesday, May 20th, Nvidia earnings. SanDisk is not Nvidia, but Nvidia is the North Star for the entire AI infrastructure trade. If they miss, or even if they beat, but issue cautious guidance, the entire sector, including SanDisk, will sell off in sympathy. Then, Thursday, May 21st, the Samsung strike officially begins. Expect serious volatility. Thursday morning, as the market scrambles to price in exactly how much global memory supply is going offline. These 2 days are the make or break window. So here is your actionable blueprint. The line in the sand is $1,410.86. If price is holding above that level, your first upside target is $1,423. Your second target, where you should be scaling out of most of the position, is $1,448, and if you get a genuine breakout candle, $1,470 is in play, though I would be cautious holding past $1,450 this week given the technicals. On the downside, your first support is the psychological $1,400 level, second support is $1,386, and your hard stop, the get-out-at-all-costs price, is $1,315.75. That was last week's low, and if we close below it, the short-term bullish thesis is dead. Execute it like this. If price opens above $1,410.86 on Monday, you can consider scaling into a long position, but use those two targets to take profits along the way. Do not hold it like a long-term position in the middle of a high volatility week. If price is below that pivot, do not try to catch a falling knife. Wait, Watch for the stock to find structural support at $1,386. If it bounces there on high volume, that is your entry. If it breaks 1,315, you must respect the stop. Period. This is not about being right about the company. It is about being right about the price action during one of the highest volatility windows of the year. And for those of you with a longer time horizon, here is why the fundamental story still makes this a company worth watching for months and years to come. SanDisk is carrying zero long-term debt, $3.7 billion in cash on the balance sheet. They have authorized a $6 billion share buyback program. When a company buys back its own stock at scale, they are telling you in the clearest possible language that they believe the shares are cheap. And the metric I want you to bookmark above all others for the next 6 months is the 78.4% gross margin. As long as that number holds, SanDisk is the undisputed king of AI memory infrastructure, and every major cloud provider building out their data center capacity needs what SanDisk makes. Now, before we wrap up, I need to include an important financial disclaimer. Everything discussed in this video is strictly for educational and informational purposes only. Nothing here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. All investing involves risk, including the potential loss of principal. Always conduct your own research and consult with a qualified financial professional before making any investment decisions. Past performance is never a guarantee of future results. Short-term, neutral consolidation with high volatility. Long-term, the AI transformation driving this company is real, it is structural, and SanDisk sits at the backbone of it. And with that, here is my question for you. Given the AI fundamentals, the Samsung wildcard, and Nvidia earnings on Wednesday, do you think SanDisk breaks above $1,500 before the end of May, or are we heading into a deeper correction first? Drop your answer and your reasoning below. I read every comment, and I want to hear where you think this goes. If this strategic audit gave you value today, hit that like button. It helps Smart Stock Sam reach more investors who need this information. Subscribe if you have not already, because we do deep dives like this every single week on the stocks that actually matter. And if you want to go the extra mile in supporting this channel, send a super thanks. It keeps this research free and this channel running. I will see you in the next one. Stay sharp, stay disciplined, and as always, trade smart.